The crypto crash adds pressure to DeFi tokens already in a declining spiral. This weekend's crypto flash crash served to highlight the recent cooling of decentralized finance, which was once one of the most exciting sectors of the digital asset world. While Bitcoin and other rival coins have mostly stabilized or increased from Saturday's lows of about 20%, many DeFi tokens fell even further and have since failed to recover. The DeFi Pulse Index, which measures the performance of tokens such as Aave, Balancer, Compound, Sushi, Synthetics, Uniswap, Yearn, and Badger, fell as much as 24%. The slide follows a period of poor performance for tokens associated with decentralized finance applications, services that enable individuals to lend, borrow, and trade directly, without the use of intermediaries such as banks. Over the last 7 months, the DeFi Pulse Index has fallen 62.5%. By contrast, Bitcoin is still higher than it was in mid-May, despite the recent slump. For the majority of the last 6 months, DeFi has been out of favor and underperforming other sectors, and that trend continued over the weekend, said Jeff Dorman, Chief Investment Officer at Arca. However, other tokens recovered much more quickly, whereas DeFi remained depressed. Slump of DeFi tokens. The DeFi Pulse Index, which tracks key tokens, continues to decline. To be sure, the total value of money invested in apps, a proxy for usage, has increased 12% since mid-May, to nearly $100 billion, according to tracker DeFi Pulse. The services are geared towards a portion of the world's unbanked population of 1.6 billion people who lack access to traditional, centralized financial services. However, many investors have shifted their focus to coins tied to non-fungible tokens, frequently digital art, or games. DeFi has taken a beating in part because many of the tokens are held by a small number of people, according to Simon Judd, head of business development at Index Coop, which manages a DeFi index fund. Numerous DeFi tokens have extremely low liquidity, Judd explained. Thus, even a small amount of sell pressure has a sizable effect. DeFi's injuries are also partially self-inflicted. Last week, Badger DAO, which allows users to earn interest on Bitcoin, was hacked. The precise extent of the damage is unknown. According to one researcher, it could be as much as $120 million. Meanwhile, at Sushi, developer infighting adds to the uncertainty. Concerns about a possible regulatory crackdown are also dampening enthusiasm for DeFi. The Financial Action Task Force, which develops anti-money laundering standards that governments around the world follow, recently called for increased oversight of DeFi apps. While many claim to be run by their communities, the FATF warned that governments could hold developers responsible for failing to conduct customer identification checks and enforce anti-money laundering policies. Today, the majority of DeFi apps allow customers to remain anonymous. While not a DeFi platform, state and federal regulators in the United States have recently taken action against companies such as BlockFi, alleging that their savings account-like products violate federal and state laws. Non-bank financial intermediaries, NBFIs, can improve the efficiency of the financial system but also increase its instability, the BIS, which serves as the central bank's bank, stated in a December report released Monday. Additionally, this instability affects token valuations.